Welcome to the Real Talk Retirement Show, where we explore the financial side of retirement and beyond. Whether you're currently retired or planning for the future, we offer real, relatable conversations about money and personal finances. Most importantly, we dive into all these topics using real talk. Now, let's get real about your money and your retirement.
Hello, everyone, and welcome to another episode of the Real Talk Retirement Show. I'm Brian Graff, a retirement educator here with Conrad Siegel. Now, our loyal listeners, which we have many, know that I am joined every episode by my colleague Tracy Burke. However, we're going to give Tracy an episode off. I promise it wasn't for bad behavior or anything like that. And in his place, we do have a very special guest. Today, I am joined by Dave Lytle. Dave is our Chief Investment Officer here at Conrad Siegel. He's a partner in the firm, leads our investment research team, and consults with many of our valued clients. So, Dave, welcome to the podcast.
Hey, thanks for having me on, Brian. Really appreciate it and look forward to trying a new format for us to have these discussions.
Absolutely. We're going to have a good time, Dave, I promise.
Sounds good.
But, Dave, we brought you in today specifically to tackle the elephant in the room, at least most of the rooms that you and I visit these days, which is market unpredictability. Now, we could replace that word unpredictability with a much stronger, maybe less friendly word, but let's stick with unpredictability as we dive into things. So, Dave, can you start us off by discussing, what's going on right now? And to timestamp this, remember, we're in early 2025, but what's going on now that has investors panicking a bit and unsure what to do with their retirement investments?
Yeah, absolutely. So right now, if anything investment related, you have the normal earnings, interest rates pop up, but tariffs. Tariffs is the key word that's coming up constantly, and very smart to timestamp this. I've been saying that, with the market moves we've seen both up and down, the volatility, data is going stale incredibly quick. So we are doing this recording early May. Things, could change quickly, but we do think that we'll give you an update on where the markets kind of stand, but the steps we're going to talk about of, thinking of market volatility, how do you invest through it, how do you kind of go to sleep at night, those kind of hold in all situations. So starting off kind of what we're seeing right now, tariffs have been big really the whole year. President Trump was very direct on, he was going to use tariffs, got back into office when he was campaigning, came back into office in January, and he has held true to that campaign promise. So really the first, January and February and March, markets were down. A lot of that was on tariff stress. So, it started with tariffs on Canada and Mexico and China, and then some more targeted ones on sectors like metals and autos in Q1. So markets were already a little stressed about tariffs and the idea of, okay, tariffs get paid when products come into the US. How's that going to impact pricing? How's that going to impact consumer confidence and spending? Is there going to be a business shift because of that? Are companies going to spend less or we'll have kind of an economic slowdown? So market was already kind of keyed on and kind of stressed about this. But then we got a big shift on April 2nd. So there was a big announcement after markets closed. President Trump was in the Rose Garden and they kind of rolled out these reciprocal tariffs, what they were labeled. So everyone was very keyed into this address. It got a lot of attention. And what we saw come out of it was actually very different than market expectations. So the reciprocal tariffs, everyone was thinking the idea was going to be, okay, well, if you have a tariff of 5% on the US, we'll put a tariff of 5% on you. We actually got something very different where it was based much more on trade surplus. So the idea was that it wasn't necessarily tariff driven, but if we buy more stuff from your country than we send to it, we're going to give you a tariff, thinking this wasn't a fair trade practice. So to give you an idea, kind of the scope of it, leading into this, tariffs were about 2.5% on average for U.S. imports. And this had actually ticked up in recent years with some levies put on place by Trump and Biden in both their administrations. So everyone's thinking, okay, 2.5%, the average tariff for the U.S. on our exports is about 5. Maybe things will double here. Actually went up to 25%, so increased by a factor of 10. So market was not ready for that, and we saw a huge sell-off those next 2 days on Thursday and Friday.
Right.
So it wasn't a big one-day move historically, but the 2-day move we saw actually got put in consideration of, the biggest since World War II. So, the flash crash we had back in the late 80s, great financial crisis or dot-com type moves, it was up there. Markets are obviously very stressed, and there's already be discussions about, you know, will this cause a recession? How big a recession? How quickly is it going to come in? The market was very anxious here, and the market also got very volatile. Think, okay, maybe these are negotiations versus long-time policy. We got some different, feedback from administration on what that was, where certainly open to negotiations and have more fair trade, but at the same time, they're saying, these are here to stay and they're going to drive a lot of revenue. So market wasn't quite sure what to make of it. And then again, just a couple days later, the following Wednesday, we got a 90-day pause to a lot of these bigger tariffs. And the market reacted just shot skyward. Brian, you and I were actually in the office together, if you remember. And I had apologized at the time that I had my phone on the table. And I was just hitting refresh because we were in that type of market
Yeah,
environment where I wanted to see what was
I,
going on. I wanted to keep tabs on it.
I definitely
And
remember that day, Dave. Yeah.
things were choppy and I was giving updates once in a while, just watching it. Then, we left that meeting. I do a couple of things around the office and I went out to drive home in the parking lot. I pulled up the app one more time just to see where it was. Markets had shot up. I mean, 6, 7% at the time. I actually sat in the park and I'm like, what the heck happened in the past 20 minutes from when I put my phone away till I got in the car? And it turns out we had this pause and ended up being one of the biggest days ever for the S&P 500% gain. Just
Hmm.
astronomical gains across, pretty much all industries, all stocks. What's interesting here is that looking at this, we were paused the biggest tariffs. Those tariffs on Canada and Mexico and China were still in place. The 10% base and all imports still hold. So we're actually at a much higher level than we were at the start of the month, even what expectations were, but it wasn't as bad. And it gave hope that a lot
Yeah.
of these might be negotiated, they might change. The market took that very, very, favorably.
Yeah. Investors were just looking for a glimmer of hope, kind of, right, Dave?
Correct. Like it's not good, but it's so much better than where we
Yeah.
were that was all the excitement. And, that's something we talk about, historically getting into that larger picture. We see that a lot when we look through past market stress where these best and worst days happen really closely together. And doesn't, it's true in a lot of times with these market events that the rebound's very swift, but even on the way down, you get these times where, hey, maybe things are oversold or maybe we're in a type of environment right now where things are going to change and you get these huge rallies. And there's some great charts out there by a bunch of different providers that, how impactful it is missing these great rallies. And, if you sold out after Thursday and Friday, it's hard to say that, you weren't looking and making up a stressful scenario. There was a lot of stress in the markets. There was real world concerns there, man. But if you missed that Wednesday, if you went to cash or sold out a lot of your equity holdings before that day, really could have long-term impacts on your portfolio.
For sure.
So looking at that, the idea of, investor sentiment, like what do we really expect and how do investors really kind of handle this? So, looking at what we saw in those early April, it's hard to see those dollar losses. And I know you mentioned this speech, Brian, too. You hear people say that, like, hey, I looked at my portfolio and I lost X dollars of those 2 days. Like, we are seeing those comments a lot.
Yeah, we see them all the time. And, I try my best to remind investors that, it's really only on paper, right? We're online, I guess you might say these days too. But until you make that sale and, get out of the investment, you have to really convince yourself that I still have the same amount of units or shares in this investment that I had the day before. The value just happens to be a little bit down. So it's a psychological game, which we've talked about in some other episodes.
Yeah, and it's so fluid that if you think of, 23 and 24, I mean, there was just fantastic gains in the equity markets. Investors really benefited. So, yeah, you did your your portfolio is worth less than it was earlier. There's no way getting around
Right.
that, but you're right, you're essentially giving back some of those great gains you had earlier. And if you do sell out, you lock in that loss. If you stay invested, then, that loss and gain continues to be fluid kind of moving forward. But, it's hard to see that dollar loss.
Hmm.
And there's a natural instinct like, I need to put a floor on it. Yeah, I might have lost this much, but I don't want to lose more. But when, we talked about, those rallies happen and they happen unpredictably. And I mean, to be honest with you, a lot of the gains we've seen in April, it's hard to really reconcile them sometimes because these concerns, these long-term problems or hurdles or difficulties we talked about in early of April, they're still there. They haven't been resolved. We haven't gotten more certainty around them.
Yeah. Yeah.
So, I mean, that's the whole idea is that, if you say you sold out, you're like, I'm done. I'm gonna kind of wait until this resolves. The problem is you might not have any more dollar losses, but that opportunity cost. The idea that,
Hmm.
if I had stayed invested, I would have gotten that, 8% rally on that Wednesday. So yeah, I didn't lose any more dollars, but like what opportunities did I lose by making kind of those short-term moves? So like I think it's always good to think about that cost too.
Yeah, huge part of the equation for sure.
So, looking at the current environment, I think it's really important too to think about the idea that, sentiment is important to the markets. Obviously, that, whether people are optimistic or they're pessimistic, it can move the markets. So there's something to that. But in this current environment too, sentiment is so fluid. You think of some those past big crises you think of, the COVID crash,
Mm.
the great financial crisis. There was this external shock that was trying to be understood, couldn't really be controlled. I mean, we had to work through it and kind of figure it out. This tariff is definitely an external force coming in impacting the markets, but the level of control is very different. So the administration has put these tariffs in place, and they've shown themselves to be very nimble and fluid in, making pauses, making exceptions, shifting, and maybe if we get trade deals, they'll remove them, and they could, if we don't get trade deals, they could get changed in a different way. We've seen with China, their tariffs have increased a lot as China's responded, given some tariffs on U.S. goods. I think currently it's standing about 145%, which is almost an embargo. If that number were to come down, if we had some real progress with China, it could be a huge shift in market sentiment and performance. So, I think in this situation, with the control the administration has, it's one of those things to know that sentiment can really turn on a dime, and we've seen it do it there too. So, just one more thing to be thinking about as we kind of try to navigate this situation.
Yeah,
Um,
for sure, Dave. It's crazy, and you think about the last two times we had like this. You've got the pandemic, right, which is one totally separate thing, way different than tariffs, right? So the event that caused this market stress and the volatility were, tariffs versus a pandemic, two completely different things, but really the reactions to investors and the uncertainty, that's what's so similar. And we've seen it before in history with other types of events. We're going to see it again. So this is nothing new, at least the volatility, the uncertainty. So I think the logical next thing for us to talk about, Dave, would be, whether we're talking about early 2025 or maybe, 3 years from now in 2028, if something happens again, what are some practical steps we can take? What are some things we can do as long-term investors to kind of protect ourselves from making bad mistakes with our account, to feel a little bit more at ease with the market environment? And I think the first thing I'll bring up is something that we say all the time here at Conrad Siegel: be diversified within your portfolio. Don't put all your eggs in one basket. Have exposure to several different asset classes and market categories, which really helps ride out the storm in difficult times. Can you talk a little bit about the importance of diversification in a portfolio, Dave?
Yeah, absolutely. And, it shouldn't come as a surprise to your listeners that, the things we're going to talk about aren't these really cutting edge exotic strategies. They're
Right,
kind of those tried and true investment principles, but they can be really impactful, and, they're not always easy to do in stressful times. So the first is diversification. So the idea that, yes, the US equity markets have really had a rough run in April, but that's a good thing to think of is, we recommend a diversified portfolio. So you're going to have, fixed income, domestic equity, and foreign equity. And looking back, the month of April actually turned out to be not that bad. The idea of S&P 500 ended down, I think, less than 1%. So it had a huge rally in there, but fixed income was up 0.4%. Foreign equity was up 3.6%. So the idea that if you had all your exposure to the domestic equity market, you felt all of the pain, all the huge drops we had saw going on. If you actually had some diversification, you had your fixed income, you had your foreign equity, which have been out of favor in recent years. And we kept saying, it's okay, there's a reason to keep them. They're going to help in different market environments. We saw that play out. And, if you look kind of at some intra-month data, it plays out much better. So on, before the big rally we had with the pause, we saw from their peak levels, the S&P was down 19% about. Small caps US are down closer to 25.
Mm.
So, we always say a bear market's a loss of 20%. So
Yeah.
S&P 500, I think intraday it might have got there. Small caps were firmly in that. So you had that big sell-off. Bonds were down a little bit. Foreign equity is down about 10%. So they had losses, but not nearly as big. So there's a real diversification kind of benefit you can see there. If we actually step out to, year to date, you can see it'll come through a little bit more. So we mentioned, this tariff talk has really ramped up in April, but it's been present pretty much for all of 2025. So I'm showing that, in 2025, S&P 500 is still down about 7.5%, and other portions of the market, maybe mid and value or growth style equities could be down even more. At the same time, fixed income's up over 2.5%, and foreign equities up close to 5. So there you kind of see that diversification impact. And I know some of our clients have been pleasantly surprised when they see their kind of recent performance and they're only down 1 or 2%. And they're like, oh, that's
Agreed.
that's actually
Yeah.
not that bad considering what we've gone through. And part of it has been the idea we stayed invested. We saw that rally in the second half of April, but the other part is we weren't all in on domestic equity. We had exposure to these other buckets, and it really did add some value.
Yeah, for sure, Dave. So diversification, you can see, really mitigates some of that downside risk that we're taking as investors. We also talk about the idea of rebalancing a portfolio as well. Some comments on that, Dave?
Yeah, so rebalancing, again, not a very fancy or, we're cutting edge idea. It's just the idea that if you have a long-term target, you should be going back to it. So, selling the things that have done well and buying the things that are down low. I will say for a lot of investors, rebalancing in up markets is much easier. It's much easier
Mhm.
the idea that, hey, the stock market's done great in 23 and 24. I'm gonna lock in some of those gains and buy bonds.
Yeah.
That's a much more natural kind of reaction. Rebalancing when equity markets have done bad is not as easy, but it's just as impactful. You kind of have to do both sides of the coin here to get the full benefit. So there, the idea is that, okay, things really sold off the first half of April. If I had a 60-40 portfolio, maybe my stock exposure is lower than I want it to be. You know what? I'm going to sell some bonds, and I'm not saying it's going to be the market bottom right now. There's
Mhm.
no call on that, but the whole idea is things are much less expensive than they were just a couple weeks ago.
Right.
I'm going to get back to my target, try to buy low, and there's a lot of things in there that, buying low is really impactful. And even if the market does go down more, just kind of doing that constant approach and capturing those when things are a little bit lower, have more exposure there. When you do have rallies going forward, it can be really impactful. So, we recognize that there's been a big rally. There's still a lot of market risks out there, but it's a good practice to have at all times. And at the same time, too, with rebalancing, it's impactful that if you had that great 23 and 24, if you didn't rebalance at all during those years, you were going to be overweight equities coming into this. So that would be a little bit of extra pain too. So, if you were, very regimented, rebalanced in late 24 or maybe early 25, you came into this sell-off not overweight equities, and then you maybe had an opportunity here to add some to equities when things had sold off and kind of get a little extra boost to your portfolio from that technique as well.
Yeah, Dave, I think it's good to point out too that a lot of retirement plans kind of have built-in tools like automatic rebalancing within their portfolios. That way,
Yeah, absolutely.
every 3 months, just without you having to do anything as an investor, the system, will automatically, kind of sell and buy to get you back to your original portfolio objectives. And when you add like one of those automated tools in this case, it kind of prevents again, keeps the emotions out of it. You're not trying to time the market. It's just the mechanism of those portfolios. So I think that's very helpful as well, if offered through your retirement plan.
Yeah, it has that disciplined approach where like
Yeah,
you say like, hey, I'm going to do it. I'm making this decision once, and then it kind of is done for you.
happens automatically. Okay, good. So that's our tip number one. Just make sure kind of going into these market environments, you are properly diversified. You're rebalancing your portfolio either, on occasion or through an automated tool. I think the next thing that's super important, Dave, for all investors is to make sure you're taking an appropriate amount of risk within your portfolio. So, how you invest your money early in your career versus the middle of your career versus pre-retirement should be probably different for most people. And somebody that called me in panicked a couple weeks ago when the market was not behaving very nicely. If they were a year or two away from retirement, but they were taking a appropriate amount of risk, they were a lot more confident about where things stood than the 65-year-old that was still maybe 90% or 100% equities, right? Because they were taking an appropriate amount of risk for their age. So risk comes into play quite a bit. Wouldn't you agree, Dave?
I agree. It's like you said earlier that, those losses get locked in when you sell. And
Hmm.
if you're looking at a retirement plan or even a young investor, if you're in your 30s, you're not realistically, you might not need to sell if that money is saved for retirement. So you can kind of ride down those ups and lows and have a higher equity exposure. Now, if you're closer to retirement or, you're a young person who's putting money aside for a house and you're like, okay, I'm gonna have to kind of liquidate this portfolio in the near-term horizon, then it's a very different, strategy. So I agree that, the idea to kind of ride out underperformance and stay invested for long terms versus, no, I need these funds for other things. They need to be
Hmm.
sold out and used is very impactful. And I'm a component of always having some fixed income in a portfolio, especially with yields being higher now. I think it can offer some
Yeah,
competitive total return, but I think that as we talked about diversifying and rebalancing, I think always having some fixed income really allows you to do those things better. And then certainly as you go through the risk of early, mid, retirement or short-term savings, that's when you really factor in that risk and the allocation becomes really impactful.
absolutely. So those are some things you should do, we think, as a prudent investor. Diversify, rebalance, visit your risk profile, make sure you're invested appropriately for where you are in your career and your retirement goals. Maybe we can now talk about some things you might not want to do, Dave, as a long-term investor, and maybe try and avoid some common mistakes that we see all too often. So the first thing we'll talk about here is, and I mentioned it earlier, timing the market. We recommend for most people really trying to avoid market timing, constantly trying to predict when the market's about to drop. So you sell out of your riskier investments. And let's say you get that right. Then it's trying to also buy back into the market before it goes back up. So you have to be right twice to be an effective market timer. And again, we don't think that that's a great idea for long-term investors.
Yeah, I agree. And I was saying too, like, the chief investment officer for me always said you had to be right twice. And if you get one of those wrong once, it can undo a lot of the
Yes.
gains you might have captured before. So it can be really impactful. And the tough thing of timing the market too is, the market tends to be very forward looking. So even if you said, thinking back to the COVID crash that, hey, when this COVID risk started kind of popping up in headlines, this is going to be a big deal. And you essentially got very
Yeah.
conservative or exited the market even, you know, I think the market's really bottomed out there in late March of 2020 when the Fed came in with some pretty unprecedented and very large policies to support the market. We all lived through COVID. It didn't bottom out in March of 2020. It was very impactful, impacted our lives, our abilities to, travel, spend money, do business for much longer after that. And that kind of plays out throughout history where, the market bottoms well before the actual event gets better. So it makes it very tough to time. And, I kind of also recognize though it's human nature. You feel like
Of
all this is
course.
going
Yeah.
on, like I need to do something. I can't just sit here. So Brian, I know we both enjoy some sports. I'm a big hockey fan. I'm enjoying the NHL playoffs right
Yeah, it's
now.
playoff season. That's right, Dave.
It's on. I actually can see it. It's on TV more often. I'm really enjoying it. But I actually go to a hockey comparison here, where in hockey there's rule. There's no fighting. But then when you do fight, here are things you have to follow. So we kind of say the same way with market timing. Okay, don't time the market. If you're going to time the market, here are some things to think about how you're going to go about doing it. So the first thing I think of is that the idea that, maybe think about overweight and underweight. So a lot of times I think of investors if, they're nervous about the market, they go to cash. Or if they're really bullish on maybe something happened, they're say like, oh, I'm going 100% equity. And that's really a very aggressive swing that can be really impactful, both
Right.
good and bad. And the bad can wipe out, again, any good you might have done. So the one thing I really think of here is the idea of overweight and underweight. Now, I hear a lot of institutional investors, like the big fund shops, the big banks talk about it. And, maybe you have a 60-40 portfolio and you're thinking, hey, like, I have real concerns about equity markets. What maybe valuations are high, or maybe this crisis is going on, you think it's going to get worse. Maybe you drop down to 50-50. You make kind of that incremental
Mhm.
change. So
Yeah.
obviously our first line is always don't time it, but then just things to think about if you're going to time it. Another thing is that, don't stop contributing if you're saving, whatever it is, whether it's retirement plan towards a house, anything like that. But, maybe you're strategic about how you walk in new money. Again, don't sell out what you have, but you can kind of think, hey, I'm going to keep contributing, but maybe I'll let it sit in a money market for a week or two, then I'll put it in. Again, if you're going to take steps, it's something reasonable to do. I think the one that's actually probably the most healthy we talk about when it comes to timing the market is rebalancing. So you
Hmm.
got your portfolio and maybe you saw things really sell off with the announcements of tariffs. Rather than going 100% equity, you could say, "Hey, I'm going to a special rebalance. I'm gonna take my equity port back up to target now, kind of off cycle." So I think it's one thing is that, don't rebalance because again, sorry, always rebalance. Don't time the market. Because if you're wrong once, it can be so impactful. But if you're gonna kind of make some of these decisions where you think you need to do something, do small incremental things. Don't make those big swings with, I think Tracy has a great saying, don't make short-term decisions with long-term money. And I
Yeah,
think
I
that
use
really
that one a lot
holds
too.
holds through here.
And baby steps. That's a term I use all the time too, Dave. Take baby steps when somebody's panicked on the phone and they're really nervous about where the world's headed. I don't want to tell them all the time, just don't do anything, just forget about it, you know. But maybe if you're going to make a move, just do it small. Make a small adjustment now, revisit again for 6 months, a year from now, and maybe look at changing something again. But avoid those big drastic changes in your account.
Yeah, I agree. And said too, and we talk all the time that, you know, if you're at 100-0 and you're really nervous about the equity market, it might be a good time to think too, should I be 100-0? Because this is kind of extreme circumstances, but you should have kind of that allocation lets you sleep at night and not think you have to market time to be positioned for what's happening right now.
Yeah, yeah. Hey, Dave, shifting gears a little bit, but I don't want to forget to ask you this. What about the notion of let's buy gold? You know, I get that a lot now too. Anytime the market's very stressed and people are worried about the direction of the world, inevitably I get callers that say, I'm just, what do you think about selling off my stocks and just buying gold? What do you think about that?
Yeah, it's one of those things like the whole idea of like chasing returns is kind of factors right now too,
Yeah.
because gold has been on quite a run. I mean, it's
Hmm.
delivered some very big returns. You can talk about inflation hedges or, kind of concerns of the stock market. Gold prices have just skyrocketed. So I think, the idea of buying gold might even be getting more headlines right now, just because people have kind of seen what it's done. Um, we're not big gold fans here personally, just because we recognize, it's a store of value. It's people think it's been around for thousands of years. A lot of currency used to be tied to the gold standard. What we don't necessarily like about gold is that, there's no dividends, there's no interest. It's just kind of holding that physical commodity. And the whole idea is that, that's only really worth what something's being willing to pay it for you in the future. So
Hmm.
that can be up, that can be down, but if you hold a
Yeah.
bond, you're promised to get back the same amount plus interest. There's always a default risk, but that's pretty low if you hold high quality bonds. So our thinking is that, you know, some people want some exposure there, but we think it's really a good long-term investment because it's all based on price change. There's no idea of, owning a business that has some earning stream or owning a bond that's going to promise you interest payments. So it's something that we tend to encourage, investors to stay away from, or if you're going to have a small holding, have it be a small allocation. Don't have it be, a big kind of
Right.
center portion of your portfolio.
Right. Yeah. So avoid chasing those returns of gold or any other hot stock or mutual fund component. And most important thing, we say it all the time, Dave, I think, is to really stay invested. Another saying at Conrad Siegel here is that it's not about timing the market. It's more about time in the market. So, try to avoid exiting the market just because of your emotions. Don't be overly aggressive when you're close to retirement, but don't be overly conservative in the early part of your career either. We want to make sure we're maximizing our returns, but really just stay true to your objectives. Be in the market, and historically speaking, things have always worked out okay.
Yeah, I think it's a good thing to think of too. And the whole idea too is, invest in a way that lets you stay in the market too. I think that'll coupling those two together is a really strong tool that stay in the market and be invested in a manner that lets you do that without, financial hardship or a lot of extra stress.
Yeah. So I think we've given our listeners, Dave, some things to think about, some things maybe to do within their portfolios, and things maybe to not do within their portfolios, based on circumstances. But as we kind of wind things down today, I'd always like to go over some action items, some practical steps people can take, or maybe some tips that we can pass along. And I'll start off by saying this one's a huge one for me. We may have touched on it a little bit earlier, is really try and avoid checking your retirement account balances every single day. Most 401k or 401k type plans out there are daily valued. So technically, you could log on to your provider's website each day and see your account either went up or down depending on how the market performed. But it's really frustrating. I don't know if people have the stomach to do that, Dave. And something I hear all the time from people that do check daily is, well, my neighbor Joe, he lost $100,000 in 2020 when COVID hit. And my normal reaction to that is, did Joe really lose that money? Did he sell everything and not buy back in? Or was it just a short term, paper loss because he was looking at his website every day? It went down 100,000, but, he forgot to mention that it went right back up, a few weeks later. So you agree, Dave, checking balances every day, not necessarily the best thing to do.
Yeah, I think too. You think of like, you could say lost or like gave back some gains, which I think you could say certainly right now in 23 and 24. And yeah, I agree. I mean, I keep a very close watch of the markets with my job here. And,
Right.
even intraday, I'm looking at the markets too, but I tend to not look at the idea of, well, how many dollars is my account up or down? So I think that
Yeah,
adds like extra emotion to it. That's
it
probably
does.
not helpful. So I think absolutely be informed if you want to be. Nothing wrong with being well read, understanding what markets are doing, but I agree, like putting dollar terms on it on a real frequent basis. I'm not sure if that adds investment value. I know it does definitely add stress.
Yeah, 100%. So know what you have in there, know how you're invested. But again, the daily checking, maybe not the best thing. Something else I talk to retirement savers about all the time is really trying to avoid pulling money out of your retirement account. Like I know sometimes it's people think that if the market's not doing very well, why am I in the market? I could use this money to pay off other debt. I'm just going to pull it out of my account. Enough of this already. And I always like to warn people too, when you take early withdrawals or distributions from a retirement account, not only is that money you're giving up on in terms of, compound interest and market returns, but there's tax implications there. A lot of times you do face a 10% early withdrawal penalty if you're under age 59 and a half. So, unless it's a real emergency, we do typically recommend that people avoid taking money out of their retirement accounts.
Yeah, I think you're right. The power of compound interest is a strong one. So keeping it in and let it accumulate over time can make a real difference.
Yeah, and again, going back to the risk thing, that's another action item. If you haven't thought about how risky your portfolio is, it's never a bad time to revisit that. Take a risk quiz if your provider offers one, or talk to a financial advisor. Especially when you get closer and closer to retirement, a good financial advisor is certainly worth their weight in gold. So going back to the gold reference, so you do it on your own. Talk to a professional and just make sure you are taking the appropriate amount of risk now to achieve your future goals.
Yeah, and I think it's a good thing to think of too is, it's not just age based. That certainly is a portion of it, but
Hmm.
if you're someone going into retirement and you have a large pension, you have a large social security, maybe you don't need as much from your investments, so you can be more risky. And I've talked to other people who are much younger and they say, "Hey, I'm saving up for a car, I'm saving up for a house in the next year. What should I invest in?" My response is money market or short-term bonds. Like
Yeah.
a 1 year time horizon where you plan on taking everything out, like that doesn't really line up with equities. Even if you are in your 20s or early 30s, like that's still a mismatch. So I do think it's, good to take a risk quiz and like it's good to think too, it's not just how aggressive you are, it's not just the idea of how old you are, it's the idea too of like, well, what are the circumstances? What else do we have going on in the picture? And that can make a difference.
Yep, great point. And then once you take that risk quiz or that assessment, then make sure that your current investments that you have in your retirement plan. We always like to focus on retirement here. Make sure it lines up with your risk quiz results and your long term goals. So again, we go back to asset allocation, diversification. Dave, huge factor in all this.
I agree.
And then very important, everybody, keep saving. I know, again, we talk about human nature, we talk about emotion. Why would I want to save in a market that's acting really wonky? I'll use that very technical term, wonky. Why would I do that? But remember, when you continue to save for retirement, making regular contributions, you're using dollar cost averaging, which we talked about in previous episodes. You're kind of softening the blow when the market's down, and you're buying some of these investments at a discounted price. Is that all? Would you agree with that, Dave, too? I mean, keep saving.
Yeah, I think keep saving is really important just because, if you skip those months of saving now, it's pretty hard to do extra saving in the future. It's much easier to have it budgeted, be consistent, keep those savings going in, whether it's to, a house fund or retirement fund. It's good to kind of keep that disciplined approach. And
Mhm.
I agree, everyone was good investing in 23 and 24. Those prices were much high, especially late 24, much higher than they are now. And certainly I can say too, if you look at, different valuations, portions of the market are less expensive now. Some portions are still have a higher price tag, but we've seen too is we don't know where the market's going. So I think that dollar cost averaging is good to lead into. And by having that approach, yeah, you're not going to time the market perfect, but you're also not going to be wrong. You're doing a very, tried and true, consistent approach that,
Right.
will you be the biggest winner? No. But will you have a probability of success going up? Yes. And that's kind of our approach of like, let's make sure we're doing everything we can to meet our goals versus let's have the best score up there.
Yeah, great point, Dave. And yeah, thanks. This has been, I think, a very productive session. I hope there were some things that Dave and I talked about today that really resonate with you. But if, even after today's podcast, you still have concerns, you have questions, just remember we are here to help. That's what we do at Conrad Siegel. So you can email us at podcast@conradsiegel.com. Please, we always like to mention at the end of these podcasts, if you liked what you heard, please give us a good review, subscribe to the podcast, tell your friends, family members, colleagues, where you found us, and we'd love to have as many listeners as we can get to help as many people as possible, because that's what this is all about. So, Dave, before we sign off for today, any final comments or words of wisdom to our investors out there?
No, I mean, I would say that April has been a roller coaster. If you feel
Yeah,
kind of stressed and tired of keeping up with it, that's not a wrong reaction. A lot of
you're
us
not
are
alone.
sharing it.
That's right.
But yeah, just keep that long-term approach, make incremental changes, and be invested in a way that meets your goals, helps you weather the storm. And Brian, thanks so much for having me on and doing my first podcast.
It's been great, Dave. I'm sure it won't be your last. We'll definitely have you on here again in the future. And Tracy, we miss you. Come back to us soon here, which I'm sure you will. And for now, we will go ahead and sign off and thank our loyal listeners and just tell you that we'll see you next time on the Real Talk Retirement Show. Take care, everybody.
Thank you for tuning into today's show. The Real Talk Retirement Show is created and produced by Conrad Siegel, an advisory firm that specializes in helping people prepare for retirement and beyond. If you want to learn more about our work or meet the team, you can visit conradsiegel.com. Information on this show is for educational purposes only and should not be considered personalized investment, tax, or legal advice. Before making decisions, you should consult with the appropriate professionals for advice that is specific to your situation.